Welcome back, everybody, to today's Market Explained. This is our first taping for July. Lots happened. We got through the 4th of July holidays, and now we're on to a full week of July. I'm Brian Castle, your host. I'm here with my co-host, Chris Reardon. Chris, welcome to the podcast.
Thank you, Brian. Glad to be here. Glad we're now entering kind of the mid of the summer right now. But about to talk a little bit about the market. So
Exactly. Well, and everybody, Chris is the director of development for FourStar, all things portfolios and marketing and development and recruiting, and is a big role at the firm. So he's the perfect guy to give us a discussion on the podcast. So again, Chris, welcome.
thank you, Brian.
And I'm the CEO and founder of FourStar Wealth, the chief investment officer. I'm the husband to Tripti and father to Quinn and Evan. And so everyone has their role in life, and those are mine. So we're glad you're here today. We're going to start out with our normal program where we talk a little bit about the markets and what the relationships are between different asset classes, what's working, what's not working, a little bit about the economy, and then things that we see out there that we think are important for people to know in the financial world. So, Chris Reardon, where are we on the markets today?
Yeah, so a little bit of interesting movements from the last podcast we did. So domestic equities is still holding that number one position, but it did start to gain some separation. It gained 18 points from the last podcast to 259. So that was interesting to see. International equities, if you guys remember, the last podcast was tied at 239 with commodities in the kind of second and third position. It has since gained 4 points, so it's strengthened to 243 to kind of overtake fully that number two position, whereas commodities held flat at 239. So it was kind of equal since the last podcast. So now we have a definitive 1, 2, 3, if you will, as far as the top three in the rankings. And then the bottom three, it's really more a simple story of continuation of that kind of pullback we've really seen kind of since the end of April. Cash is at 130. It was minus 13 from the last podcast. Currencies is at 120, and that's minus 4 from the last podcast. And fixed income is still in dead last, and it's at 99 tally points, and that's minus 4 since the last podcast as well. So not a huge amount of movement, if you will, but kind of a continuation of the trends we've seen. And it's certainly interesting seeing that commodities and international equities, although with the way that commodities behaves, it doesn't take a whole lot to say spike oil or see a surge in certain commodities. So we could see in that number 2 and 3 position change frequently over the next couple months until we get more of a definitive separation in those positions.
Yeah, so they're still tied to each other pretty closely, except for domestic equities is starting to move. And when that had some implications for our portfolios as well, we'll come into that. But Chris, I wanted to note that fixed income's gone below 100 tally points, and so that's really fixed income has just been in last place for almost 4 years now. It's not been a great place to be. Certainly, if you wanted to make money, if you want to preserve money, maybe. But the yields are a little bit better, but there hasn't been much growth in the bond market at all.
No, yeah, I mean, it's been tough. I mean, obviously 2022 was a tough year for the bond market. I mean, the bond market got hit really bad. And even though interest rates are, I'd say they definitely are strengthening a little bit here and there as the expectations that the Federal Reserve is going to lower rates kind of gets pushed out further now. And we'll unpack that a little bit more a little later. We still really haven't seen performance-wise fixed income really live up to where it would need to be to really be a more competitive asset class right now.
Exactly. And that was the year also in 2022 when normally fixed income goes up when stocks go down, and they did go down big that year. But that was the year the bond market was down as well because interest rates went up. So the normal relationship didn't work. We hadn't seen a year like that, I believe, since 1981, Chris, when the Fed funds rate hit 16.9% and rates kept going up. Anybody who was around back then remembers high inflation, high interest rates, very different environment than we're in right now. So anyway, Well, good. Well, we'll see what breaks out, and U.S. stocks are starting to work. How are we so far? I think you had the numbers for the first half too, Chris, right?
Yep. Yeah, I mean, as far as kind of the markets in general, the S&P 500 for the first half was up 6.20%, and the equal weight was up 3.83%. So it's always really interesting to see the difference between those two because it gives you really an idea of how top heavy the market is. And really, I would say in the last decade, really, we've seen the market become exceedingly top heavy, where the Nvidias, Tesla, just these Apple, some of these high profile names have really just pushed the S&P 500 up more, but it isn't necessarily indicative of the broader market. And so it's really interesting to see the difference between those two. The one thing I will highlight, I think, the equal weight being at 3.83, even though it did trail that S&P 500, is still a decent number. So it's just interesting to kind of compare and contrast those two. Then looking at the Russell 1000 value, that was actually up 6%. So that's actually a pretty good sign.
Mhm.
These tend to be more dividend-oriented stocks, value stocks. And obviously, as the name suggests, it's 1,000. So you're getting double the amount of stocks that are usually in the S&P 500. So, that's good to see. That does indicate maybe, especially from that value perspective, you're starting to get a little bit more buyers, and those are stocks that haven't been bid up and do pay nice
Mhm.
dividends or more cash cows, if you will. And then looking at the small caps, the Russell 2000, which is a good proxy for small caps, that was really interesting. That was actually down 1.79%. So
Mhm.
small caps continue to get hit hard. It continues to be a really tough environment for small caps. You can kind of navigate that, but I think with that small cap, it's really more of a value-oriented tilt for those small caps, where there's been that benefit there. So, overall market, I think we really saw some peaks and troughs, really. We saw obviously it really bottom out kind of mid-April. And we've seen it kind of recover since. And, the S&P 500 now is posting, a 6.20, is a pretty positive sign overall.
It is, yeah. Well, and then as we begin the month here, the markets are acting a little bit better. So it looks like these small caps are actually positive for the year now as we kind of enter into July. So all the major indexes are now positive. But as we talk a lot about sectors and the way we invest is we invest in the favored sectors. What are the best sectors so far for 25? And then what are the three worst? Let's go through that.
Yeah, the three best. I think this might surprise some people. The best performer for the first half was communication services. It was up 10.89%. So and that it's an interesting mixture. Obviously, it does have some a tech component, but I think it has kind of more of a utility component as well, like the AT&Ts and Verizon, which people kind of more attend to that utility. So I think it had a nice blend where it didn't get hit quite as hard as some of the tech stocks did on that downturn, but still benefited from some of the rally that occurred after. So that's the best performer. Second best was industrials at 10.71, and third best was utilities at 9.57. So really interesting there. And utilities has kind of flown under the radar a little bit, I think. But I mean, I think the big play there, everyone's heard about AI. AI coming out is going to require a lot of power. So, I think a lot of people are looking at that. And utilities also paid good dividend traditionally. So that also helps as well. I know recently a lot of the country's been in a heat wave. So that's, also helps drive utilities. So those are the top three. The bottom three, the worst performer is consumer discretionary. It was actually down 3.07%, followed up by healthcare, that was down 1.39%, and then energy, which was down 0.32%. So energy really had another, I would say, it really moved volatility wise. There it had a kind of a big rally, and then kind of faded again, a big rally, faded again. So definitely has kind of had a decent storyline, I guess you would say, for 2025 so far. And it's interesting that it's essentially came at the halfway point and is almost flat. Consumer discretionary, I think that is the big play there. I know one of the big drivers there tends to be Tesla. But I think it's also from a broader perspective. You just see consumer spending slowing down a little bit. You have a lot of the apparels, things like that, apparel makers that are brands that are forecasting less sales, things like that. And then healthcare, similar. I mean, I think you have more constriction on insurance and what's going to be paid there. You have a lot of shakeups, I'd say, that could happen in the healthcare industry from the governmental perspective as well.
Yes. Well, and then you mentioned the communication stocks, and some of those technology names were obviously hit pretty badly, and the IT sector is still lagging a little bit, but it's starting to come back up. Nvidia goes over 4 trillion in market cap
Yep.
just yesterday, which is amazing. First $4 trillion company. So some of those techs are back up, and they got hit badly in April and May, and then now they're recovering, but they're still, for the year, they're still not leading. So it's still, industrials and communication and utilities. It's kind of interesting. But, if some of these are breaking out to new highs, there's, could be money to made there and to be made in some of those big tech names. So interesting to see that Nvidia is breaking out to new highs, which is absolutely unbelievable. Um, and then I'm also interested in the fact that the consumer discretionary stocks are down. Now, obviously, it's a sign of like a weaker economy. We're seeing more and more inputs that are weaker, but then at the same time, we're seeing some inputs that are better. So, Chris, why don't we go through the economy? I know we had a jobs number today, and then you got a bunch of others.
Yeah, yeah. So a lot to unpack here. I mean, first, I guess foremost, the recency. We'll look at the jobs number that came out today. Was better than expected, and it came in at 227,000 for jobless claims. The expectation was 235,000. So, for jobless claims, obviously that's better, and that kind of follows really the trend we saw in June. For June, we had four, they do it weekly. So we saw four jobless claims numbers, and everyone kind of beat from a similar perspective where they came in maybe on average about 5 to 10,000 less, or were right in line at worst case. So
Mhm.
that's a good sign overall for the jobs market. I mean, it shows that as far as people being let go, things like that, that we're not seeing that as much. But on the flip side of that, in June, the US economy added 147,000 jobs, which is definitely a slowdown. But I think in many cases that was better than a lot of people were anticipating. But when you kind of dig a little deeper on that number, there's definitely some trends that are interesting trends that are happening. Half of those jobs were in government, state and local, so not federal. I think that's an important differentiation to point out. So half of those jobs were in government. And then of those, healthcare and social assistance, leisure and hospitality and construction, they contributed to 94,000 jobs being added. Whereas professional and business services, manufacturing and wholesale trade, those were down 20,000. So it was kind of it wasn't a broad, jobs number, if you will. There's definitely some winners and losers, if you will. And that'll be interesting. I mean, the concern there is if we get one or two sectors that are really driving the economy, and we start to see those crack, that can really drive us into a recession fairly quickly. If you have a broader rally, it's a little bit harder, right?
Mhm.
One sector gets hit, the other ones can kind of pick up the slack, if you will. So, really
Right.
interesting numbers coming from the jobs market, and I think this is really pushing to the point where the Fed is having a tough decision. Um, Also feeding that, we got an inflation read for May. The May CPI came in at 2.4%, which actually beat expectations of 2.5%, with the core CPI coming in at 2.8%, below expectations of 2.9%. So, good. I mean, it seems like inflation has been still relatively tepid, which is, I think, at this point, really important to point out because although the tariffs have kind of waxed and waned, if you will, as far as are they on, are they off, agreements have been there, they're delayed. You still have that, but mentally, people are preparing, pricing's still there. So it's interesting we haven't seen that inflation and the inflation news really impact the CPI or sorry, not tariff news, impact the inflation numbers yet so far. But
Okay.
switching over to kind of what the consumer's thinking, we got a couple consumer sentiment reads, and this is once again, it's a really interesting look here because we're kind of getting a bunch of mixed reads here. The University of Michigan, which is kind of the big one, their sentiment reading came in at 60.5, which was well above expectations of 53.5. So that's
Mhm.
good to see. Still low. I mean, usually we've seen it, in highs around 100, for example. So still definitely lower than we would like to see, but it is positive that is moving in the right direction. Whereas the Conference Board's Consumer Confidence Index, so this is another survey, that decreased to 93 in June from 98.4. So that was a surprise miss. Most people were expecting it to at least strengthen a little bit. And, once again, these are surveys, so we're getting, a broad grouping. So you never know what people are going to say. But the main reason for that decrease was the nervousness over tariffs. So, that's really interesting to see as well, I would say. So, overall, it seems like consumer sentiment is kind of, I would say, steadied a little bit. Obviously, we got mixed readings there, but I think for the most part, it's steadied, although people are still uncertain about what's going to be going on. Flipping over to the housing market, sales of new single family homes fell 13.7% in May. So that was interesting to see. So it came to 623,000, and that was well below expectations of 695,000. And a big cause for that is these mortgage rates. A lot of people were expecting them to fall. And we did see a little bit of a dip at one point, but it kind of reassured right back up. And a big point of that is the mortgage rates tend to correlate not to what the Fed does necessarily. They correlate to the 10-year projection or 10-year bonds. So it's important to note just because the Fed lowers rates, it doesn't necessarily mean we're going to see lower mortgage rates on like a 30-year mortgage, say. It might impact it a little bit, but it's not going to be maybe a significant move as people would expect. So it's important to keep an eye on and see. And then the S&P CoreLogic Case-Shiller National Home Price Index rose 2.7% year over year in April. And that was the slowest, even though it did rise, that was the slowest year over year growth that we saw since mid 2023. So it is still rising. We still have, on average, home prices going up, but we are continuing that the trend we're continuing to see is that is continuing to slow. So that is something we will have to keep an eye on. And then the last thing, like I said, there's a lot to unpack here, but the last thing I'll mention from a manufacturing perspective, the ISM Purchasing Managers Index of manufacturing activity. So just a long worded along of saying, the manufacturing activity of the U.S. rose to 49 in June from 48.5 in May. So that was positive to see, but anything below 50 is still contraction. So we want to see that number at least reach 50 and move above it to show expansion. And more importantly, that was the fourth straight month of contraction where it was below that 50 number.
Mhm.
So that's something to keep an eye on. It's positive. It's moving in the right direction, but we really want to see it get above that 50 mark, show that expansion.
Yes. Well, and so basically what I'm hearing, Chris, is just mixed inputs, right? Some good, some bad. We're not really yet in a recession, but we're not really in a big advance either. We haven't gone negative yet, we think, in this quarter. We did go negative for the first quarter on the economy, but we'll see. Anything can happen with all the changes in tariffs. So it's almost impossible to figure what all these numbers are. And even like the Atlanta Fed's, GDP now has changed a number of times, and I think everybody's a little bit confused right now.
Yeah, yeah. I mean, it's still a very heavily narrative driven market. And now, one thing I would highlight, which is interesting, is it seemed like kind of May and June, we saw a good rally within stocks, and I think a lot of that was the administration right now kind of tamped down some of the talk on tariffs. It kind of, I would say, fell to the back burner. And I think people were kind of getting a little bit more comfortable with it. Oh, maybe what's going to happen, where things are at, what the expectations are. But the narrative, Trump announced new tariffs this week, and then, so whenever we have, essentially you're kind of throwing another tariff out there, another volatility spike, that's always going to upset the market. Then people, don't know what to expect. They kind of fall back into that group. So heavily narrative driven market. And it's really hard for us to kind of, or even the Fed or any economist to really project or anticipate what's going to happen because, it can be thrown completely off course just by one statement from the president, essentially.
Exactly. Well, then Chris, it looks like also things are slowing down in Europe. You had some numbers on German exports, I believe.
Yep. Yeah. Really interesting here. I thought there's a couple numbers that came out of Germany that were interesting. So German exports declined 1.4% in May. Not a huge surprise. Obviously, that's the impact of the tariffs. With exports to the US slumping 7.7%. So once again, we're really seeing those tariffs start to bite a little bit from the economic number perspective there. But interestingly, despite that 7.7% slump, the US still remains the largest destination for German exports. So we
Mhm.
still are the largest export partner there. On the flip side, German industrial production rose 1.2% in May, with the car and pharmaceutical sectors leading the growth there. So that was a surprise. I think obviously when you have exports declining, you kind of expect industrial production, all that to kind of slow. So it was interesting that we did see a pickup there. Maybe that was just kind of a one-off random number that, will reverse next month, but potentially a promising sign there. I would say the
Mhm.
German economy has been one of the strongest from as far as economic growth standpoint and performance wise, I would say, as far as for 2025 so far. So it's really important to keep an eye on them. And then flipping over to the Asia markets, got a couple interesting numbers out of China. The Chinese Caixin Services Purchasing Managers Index edged down to 50.6 in June from 51.1 in May. So that's just a kind of a litmus test of their servicing sector, their services sector, and how well it's doing. It's still above 50, still in expansion, but it continues the trend. If that trend continues, it will move most likely in the next month or two to contraction. So that's something important to keep an eye on. Meanwhile, the same survey, the Chinese CAC PMI Manufacturing Purchasing Managers Index. So this is same survey looking at manufacturing within China, rose to 50.4 in June, and that was a reversal. So it was actually 48.3 in May. So it moved from contraction to expansion there. So from the Chinese economy perspective, that overall was promising. But it'll be interesting once again to see, and it's still not a very robust number. We could easily see that go back to contraction next month. So we'll
Mhm.
have to keep an eye on that. And then the
Mhm.
last thing I'll highlight is Japan's industrial production saw a slight increase of 0.5% or 0.5% in May. That was following a 1.1% decline in April. And that was a big surprise. I mean, we saw that April number that was off the tariffs. We expected that to continue, but it was a surprise positive number in May. Although I know some of the new tariffs announced kind of affect Japan, so we there's still a lot of headwinds there, and I would anticipate that probably decrease again moving in the future. But we'll just have to wait and see.
Yes. So again, kind of mixed signals around the world, some positives, some negatives. And obviously there's lots of debt in the world. Certainly Japan's the most indebted country per person. We're not too far behind now in America. And we're seeing gold has had a big move. It was up in June, right, Chris? But silver, wasn't there a huge rally in silver?
Yeah, I mean, gold's been the headline so far this year, and I think we mentioned this maybe a couple podcasts ago that silver we're starting to see some movement in silver. Well, in June we really saw heavy movement. It was up 9.43% in June. Silver surged. I want to say gold during that month was about flat. So we're really seeing a lot of people who fear missing out maybe in gold pile into silver and kind of try to anticipate silver's catch up there. And we saw that movement in June. So we continue to see precious metals outperform. Whereas, I think looking at energy, as I talked about in the beginning, has really been up and down. It certainly has had strong months, but it's also had very weak months, and really has been relatively flat. You look at agriculture commodities, those have been similar story. You've had some that have been stronger, but some that have been weaker, and we've kind of seen a mixed bag there. And then industrial metals have been another kind of feast or famine type commodities. So really a mixed bag from a commodities perspective. If you can pick and choose your commodities, there are definitely areas that are strengthening. But on a broad asset class based, commodities have been, which we saw here, relatively stagnant, and you can see kind of one canceling out the other type movements here.
Yes. Well, and then complicating things a little bit too, Chris, is they just recently on 4th of July passed and President Trump at 5 p.m. Eastern, big fanfare at the White House, signed the big beautiful bill, and actually it caused him a kind of a breakup with Elon Musk over the whole issue because some people still think they didn't cut enough spending. I think Trump, of course, is expecting things to be different because of the tariffs. So the Congressional Budget Office is scoring it where there's going to be big deficits, a couple of trillion more over the next couple of years than expected. But Trump is expecting growth, and so their expectations for growth would take the deficit down. They think it's even possible that there's no deficit, right? That's kind of what they're hoping for. But since we're in all new territory, we really don't know. And we don't know what the effect of the tariffs are going to be. We have a whole new set of tariff regimes coming in on August 1st. And, we had a big liberation day, and then he backed away a little bit, and then some of them stuck. Now he initiated some more tariffs. Now he's issued some more tariffs, particularly against Brazil and other countries. Some of the countries that we've cut trade deals with are down to maybe a 10% tariff, something like that. But a lot more countries are now coming to the table to negotiate. Canada was putting up some resistance. They're negotiating now. So I think, there are many people out there that are confused. We hear on the political side all kinds of complaining about, how horrible it's going to be and cutting Medicare and cutting all these different things. And then how the tariffs are going to cause huge disruption. But, a lot of that is just certainly from people who just have a problem with the president, right? The president himself is a difficult guy. He says a lot of things that rankle people. So there's that derangement syndrome, I guess they call it, that's out there. So even if Trump did something well, they wouldn't give him credit for it. But we really don't know whether it's going to work or not. He's certainly a gambler, and he's trying to make America better, I think. And that's what we think is going to happen. But, it's really, Chris, anybody's guess how this whole tariff thing is going to work out. It should be really positive for America, but the way it plays out in specifics, it's really anybody's call. And I don't think they can quantify it. An economist has numerous things they look at. We just added triple and quadruple the number of things to look at with all the tariffs. So it's very hard for anybody to score this stuff. And we're basically in totally new territory, aren't we?
Yeah, I mean, I think, then that's just looking at the tariffs. And then, just to make things even more complicated, let's throw in the Middle East complications and the geopolitical things going on there. You got the Russia-Ukraine conflict. You have China potentially invading Taiwan. You mean there's so much geopolitical things out there right now, and events that is I think impossible to really, unless you have, or from the future, it's impossible to predict what the next month, let alone the rest of the year, is really going to bring, because there's so many different major events that are kind of up in the air right now around the world. Tariffs being one of them. How are they going to respond to them? What's going to happen? What's going to be the kind of the end result of those tariffs? We'll just have to kind of wait and see.
Mhm.
I think, when you look at the bill that was passed, I mean, you're going to see narratives on news and things like that, and they want to drive views. I think that I would highly encourage everyone to kind of do their own research into it, and really kind of look as far as the impact, because people like to kind of skew the truth necessarily. I know a lot of it's as far as taking away benefits, things like that. And, maybe there is a kernel of truth to that, but maybe they're taking away benefits for people that are just kind of not trying to do anything and have no reason to be getting those benefits, things like that. So, I would highly encourage everyone to kind of do their research on it, not just listen to the news and just take kind of what their narrative that they're driving is, because they want clicks, they want views.
Yes. Well, and so with all this kind of swirling controversy, well, and actually, Chris, I should mention, Trump kind of, at least in the short run, settled the issue with Iran by bombing their nuclear sites, and so their capability is severely damaged, and that's going to set them back, and certainly take that risk off the table. But then the last couple of days, the president's been arguing with Vladimir Putin again, and they continue to go very aggressively into Ukraine, and Trump's trying to end that war. So he said he's getting very frustrated. So there's all these geopolitical things out there that could cause trouble. Are we going to put sanctions on Russia now? Do we risk a nuclear war with Russia? So there's a lot of uncertainty out there. And so that obviously plays itself into the markets and international trade also.
Yeah, I mean, yeah, all over. I mean, especially you really see some of that play out in commodities, especially. I mean, Ukraine is a big producer of wheat and certain agriculture commodities. Obviously, oil. Russia's a big producer of
Mhm.
oil. So, I mean, there's so many different levels that it can really impact the market and commodities and the world.
Yeah. So yeah, so tariffs start August 1st. They're looking for better growth, and so that we'll see who wins that argument, the Congressional Budget Office or the Trump administration. But they're clearly looking for better growth in this whole thing. And the bill they think was good to make a lot of changes in the country. So we'll see how everything shakes out. Um, Question, I guess, for us and investors, though, Chris, is what are we doing about it? Well, folks know that we have a protection plan at FourStar, and in all through the late first quarter, we were starting to raise cash, and we went to a maximum cash level, yeah, about a week prior to Trump's Liberation Day. And then the market completely came unglued and fell apart. The tech stocks fell apart, and they sold off big time. Well, now they've come all the way back up. We're almost back to where we were, but it was stubbornly stuck, not at a fully invested position. All the money we took out of the market, we're slowly adding it in, and we had three of four signals that we got to get back in. We still weren't getting the fourth one. We finally got the fourth one last week, so now our portfolios are fully invested, and the probability is that we go higher. And that's all we can really watch. The markets seem to be in pretty good shape. And it doesn't make sense sometimes here because we've got all these controversies, we've got positive inputs, negative inputs, but yet we're getting signals to get back in the financial markets. So that's where we are, and we'll see how that plays out, right? There's a lot we don't know. We try to make sure that we see those trends and play those trends. And the probability is high for a market rally here.
Yeah, I mean, I think right now, I mean, once again, Trump this week, I think threw potentially a wrench in it. I mean, once again, we don't know what's going to happen, but as I said prior, it seemed like things were settling down a little bit. We were getting some answers as far as the tariffs, what they were going to be, and we said this before. The market hates uncertainty. It can digest tariffs. It can understand what those tariffs are and apply those. The issue occurs when there's uncertainty out there and they don't know that's going to be, because that really throws a wrench in hiring and a lot of things. Because if a CEO, if an executive can't figure out, what prices are going to be, what their sales are going to be, what's the expectations, what's the projections, they're gonna err on the side of caution and not hire because they don't want to, hire people and overstep. So, I think as things settle down, as we get more of a settlement on the tariff issue, I think that's going to do a lot to really help the market.
Let's hope. Well, and there are more and more people who are getting laid off, who are staying laid off for a while. They're not finding new jobs right away. There's always a natural churn of people leaving one job, going to another, but they're finding that some of those people leaving a job are having a longer time now out. So they track all those different metrics, and so that's kind of a sign of a weaker economy. So, but yet the employment numbers are better. But underlying a lot of it was government jobs and healthcare jobs, which are government related. So, folks, we're trying to figure it out as well. We really are, you know.
Yep.
Um,
No, exactly. And I think the important thing too is a lot of the people that are being laid off are from the tech sector, which I think got overheated for a little bit, and we saw some really headline numbers as far as workforce cuts from a lot of the tech companies. But I think a lot of them, did overhired a lot during the kind of the pandemic and the
Yep.
short aftermath there. So you saw some heavy moves there, and I still think that's an industry, and I think people that were in that industry now, because they're cutting workforce, have trouble finding having new jobs. So I
Yeah.
do think it is sector specific, but
Yeah.
definitely impacts the economy.
All right. Well, we'll check in again in a couple weeks and then give everybody another update of what we see. If we see any trends breaking out in different areas, any of these economic green shoots turn into a trend, any of the negative shoots turn around and go back up, we'll keep you posted on all that. Chris, we did an advisor call yesterday. We do a monthly advisor call. We talked about a couple of other really interesting trends. Many of our investors do alternative investing, and alternatives are not stocks and bonds, right? They're real estate, private businesses, all those things. And one of the biggest interesting trends, there was a concern that the multifamily investments were becoming very, very popular and getting way overbuilt. There were so many purveyors of multifamily programs. And now what we're seeing, though, is because of interest rates being stubbornly high and the Gen Zers aren't finding a way to buy a home, they're not making as much money, perhaps, as their next generation, as the previous generation. And then also with interest rates high and the price of homes very high, the average home price over $400,000 now, which is a big number, a really big number for a new family. So they end up having to go into multifamily. So there was concern that there was a difficult overbuilding in multifamily, but now with these current trends, interest rates staying stubbornly high, multifamily investing actually might be a good place to be because we're still short about 6 million house units, but because of the pricing that's out there and also interest rates and the relative positioning of the generation that would be the first time home buyers, we're not seeing a lot of home buying like it should be. And so now multifamily might actually be a good place to be an investor again, at least for a period of time, right? So we're seeing that trend. Chris, and then the other I wanted to mention, we just saw a number in Chicago, and this is happening in all the major cities. After a number of years, some leases are coming due, and people aren't releasing their downtown office space. So even though we saw some resurgence after the pandemic of people coming back in, and some cities are mostly full, we're here full Tuesday, Wednesday, Thursday usually. A lot of people out, a lot of activity downtown, but yet vacancies are still pretty high. And so, there's an opportunity, and it takes a long time to cycle through an office change. It's a lot more than like the hotel industry that collapsed during the pandemic and recovered right away. And there were investors that did very, very well. But the downtown office markets have been pretty rough, and they're getting a little rougher. But therein lies the opportunity. So I think, though, if you have a 5 to 7 or even 10-year horizon, investing in downtown office investments and partnerships that'll invest in those could be really good, but they're only for risk-oriented investors. So many investors don't want to take that kind of risk or the time to wait and everything. But if you're looking for outsized returns, those are opportunities that when everything else is zigging and this is zagging, there's opportunities out there. So multifamily and possibly downtown office for a risk-oriented investor are places people can look at this point, Chris.
Yep. Yeah. I mean, especially in areas like, I'd say like Chicago or New York that were hit especially hard,
Yeah,
especially during right after the pandemic, as a lot of places moved south. Florida was one of the big ones, but I think you're seeing a lot of those companies and stuff kind of start to migrate back again, or you're seeing people kind of find those value spots.
exactly. So, Chris, I think that'll do it for us, huh? I think that's
Yep.
it for today. Please look at the fourstarwealth.com site and look for the leadership matrix. We always have a lot of very interesting blog posts of interesting financial issues. There's a few new ones up there right now. And then, of course, all these podcasts are available. We're going to come back and do some other interesting interviews. We did an interview with behavioral finance expert Joe Hart. We're probably going to do a follow-up with him shortly. We'll see some other interesting interviews with different players in the financial world as a kind of interim between our market commentary episodes. So that'll be it for us today, folks. Thanks, Chris, and thanks everybody for being here. And we'll be back in a couple of weeks on it with more market commentaries. This is FourStar's Today's Market Explained. Over and out.